It's me again. It's Mike Head from Ethical Screening, and today I'm talking to Jamie from Guinness Global Investors. If you want to introduce yourself and the organization, because I'm guessing not everyone knows about the organization. Obviously, they know about Jamie.
Sure. I'm Jamie Melrose. I'm a senior investment analyst at Guinness Global Investors. Um, Originally started off on the sell side at Berenberg as a battery analyst, and then moved to RPMI Railpen, one of the UK's largest pension funds, where I did thematic work into the energy transition, and also ESG and impact. And I've been at Guinness now for the last 6 years.
So, what have you seen change in that time, and what do you see as being a major obstacle's the wrong word, but issue? Where do you think we've a sustainable market or sustainable investment market has not hit the level we would hope it had, and how we address that, or how Guinness addressed that, I suppose, more accurately.
I think definitely sustainable energy, but also sustainable investing more broadly, has definitely seen a whole cycle, certainly in the last 6, 7 years. You've gone from an environment in 2018-19 when people were starting to get a bit more interested in ESG and impact. It definitely hit a peak around kind of 2021 after a big ramp up in 2020, and then some of the air kind of started to come out of the bubble. People started to get a bit disenfranchised with the space as some of those names started underperforming. But it feels now as if we're at a point where some of those equities that got a little bit overbid in 2020, 2021, maybe got into oversold territory maybe in 2024, and now they're starting to look a little bit more interesting in 2025, especially as a diversifier away from the AI theme that everyone seems to be jumping on, and that seems to be driving the broader market. So in terms of how things have changed, I mean, we've definitely seen progress, but there has been a cycle at play, sentiment, valuations. Um, in terms of clean energy, thinking more longer term, there's been dramatic improvement. I mean, to pick your time
Yeah.
period, since the 1970s, the cost of a solar module has come down by 99%. Since 2010, the cost of solar power has come down by 90%. Cost of wind power over the same time period is about 70%. You've gone from an environment in the early 2000s where wind and solar power weren't economic against fossil fuel power. It was a largely subsidy driven market, and they made up only 20 to 25% of global installations. You then hit a tipping point around 2010. Wind and solar became economic against fossil fuel power. And then they started to make up 50 to 60% of installations. Last year, wind and solar made up 92% of global new power installations. And that is not subsidies, that is economics shining through. And so in terms of the economics of clean energy supply, we have seen a pretty dramatic transformation over the last 25 years.
In terms of Guinness as an investment fund, looking at solutions and stuff like that, where are you particularly focused and at the same time excited about directing client capital and sort of um, the message behind that you're trying to portray?
Yeah, I mean, as I say, today we've got two different funds. We've got the conventional oil and gas fund where we see a deep value opportunity, kind of about a 30% value dislocation if you look at the return on capital that's implied by the shares compared to the historic relationship with price to book. On the sustainable energy side, that's the area that I've focused more on. So maybe I'll talk a little bit more about that.
Yes.
We have a universe of about 300 companies. It's about 50-50 split across sustainable energy supply and sustainable energy demand. On the demand side, you've got efficiency and electrification products. Often, when I say efficiency, often that's also electrification products like heat pumps, they electrify boilers. You also have a 3 to 4 times efficiency uplift, similar with electric vehicles when you move from a gasoline vehicle as well. So, efficiency and electrification we think about across three main end markets: buildings, industry, and transportation. Together, that's about 90% of final energy consumption. For buildings, it's LED lighting, it's heat pumps, it's efficient cooling, it's insulation. With industry, it's also the electrification of heat. We're looking for providers of yeah, industrial boilers that are becoming electric, also electric arc furnaces. Um, but a lot of the transition there is also the electrification of labor, moving from muscle power to motor power as our factories automate. That is another big driver of electricity demand growth going forwards. Within transportation, you've got the entire electric vehicle supply chain. So you have miners, lithium miners, for instance. You've got EV component suppliers. You've got EV OEMs like Tesla, but also there's trains and shared mobility in there as well. In the middle, you've got these kind of connecting and enabling technologies like batteries, which help to electrify transportation with electric vehicles, but they also help to integrate more renewables into the grid as well, connecting supply with demand. You also have electrical equipment, so think grid equipment, for instance, once again, connecting sustainable energy supply and demand. The supply side is the side that I think people most uh, easily associate with sustainable energy. So wind turbines, solar panels. We've got the entire wind supply chain and solar supply chain in there as well, but also low carbon energy generation across utilities. They sell power to me and you, for instance, but also independent power producers that sell energy wholesale into the grid as well. And also our alternative fuel names. You've got the old world, which is kind of ethanol, biomass, renewable diesel, and the new world, which is kind of hydrogen, fuel cells, and electrolyzers as well. So that's our universe that we go fishing in. And within that, we try to get broad, diversified exposure across both the demand side and the supply side. We think it's very important to have exposure across both. You've got exposure to different end markets, overlapping cycles, because energy is cyclical. It is very hard to time the market. That supply side of the universe that we talked about, so wind, solar, and utilities, there's absolutely times where you want exposure to that part of the market, 2020 being one of them. It had an exceptional run up in 2020, but there's also times where you want to be able to step away and take a little bit of money off the table. And we have the ability to do that. We can take some money off the table and put it in some of those demand side names. And that's exactly what we did.
The other one, we were talking the other day about the American gas company, and I can't remember the name of it, which was very, you were saying about the sort of the element of the more efficiently they deliver it, the more profitable they become, etc. And how gas is because if you're using gas, you're not using coal, people want to, I think one of the problems that I've encountered too many times with the whole issue around transition is people sort of want to get there tomorrow, and that might mean I'd have to turn the lights out. And it's that thing of it. I think that people don't understand timing of the transition in some ways. And yeah, great that you're traveling by train rather than by plane, but you do sort of need the train to have some way of being powered across Europe rather than flying across Europe. As I say, and it's quite frustrating because I can't remember the name of the American gas company you were talking about, but it was just such a really interesting story.
Honestly, I've also forgotten the name of the company, but that idea that the transition is going to take a lot longer than people think is certainly something that we come across a lot when talking to our investors. I mean, even in the outlook that I was describing earlier, oil growing out to 2030. Some people are surprised that oil is going to grow and that it is still growing. Some people think it's already in decline, but continues to grow out to 2030. Gas, we think that continues to grow out to the late 2030s. And again, kind of plateaus and then falls to maybe about 90% of today's consumption by 2050. So there's still a very long life for fossil fuels. And I think for the world, it would be better if we could transition away faster. But turning supply off is not the right approach. In the last 5 years, we've seen what happens when you have a supply shock and a demand shock. So there's kind of some good examples that we can root to. So within 2022, when Russia invaded Ukraine, there were a lot of concerns about the supply of Russian oil and Russian gas. And that led to a price spike and a cost of living crisis. So if you turn off the taps the supply taps without changing demand, you have price spikes, cost of living crisis. We're not going to transition that way. That is not going to be a just, fair, affordable transition. On the other hand, when we had COVID, you saw a demand shock where demand dropped and supply then had to follow. Prices dropped, oil and gas producers had to curtail their production, and you did see a drop in emissions as a result. And there wasn't a cost of living crisis either. So we believe ultimately that the transition has to be demand led rather than supply led. And that means that you have to invest in the solutions that help to reduce fossil fuel demand. And that's exactly what we do with our Sustainable Energy Fund. It's efficiency solutions that help to reduce energy demand in the first place, and it's electrification solutions that help us move from consuming oil and gas molecules to electrons instead.
I think that's a good point to finish because um, we've covered a lot in a very short period of time. And having looked at the crib that we had on the things we're going to talk about, I don't think we've talked about any of them, which is brilliant because it was supposed to be a chat with someone on your side of the table who manages money for clients and investors that are sort of my side of the table about what it is that goes on at Guinness with their money. And to be clear, we make clear that within your sustainable fund, there is not coal, there is not oil, there is maybe some gas, but that's a whole other thing. And you've explained the reason why that's necessary.
I mean, so within sustainable energy, we don't describe it as a carbon-free fund. We're investing the solution providers. Some of those are manufacturers, which consume energy, so they might be a little bit more energy intensive than software companies or banks, for instance. You also have some transitioning utilities like NextEra Energy and Iberdrola. They are leading the transition in terms of investing in the grid and in wind and solar power as well, but they do still have some gas as well, but they are actively closing down coal. But the reason I mentioned earlier, it's just not economic anymore. Gas plays a really important role decarbonising the grid, and part of that is squeezing coal out, but the other part is helping to integrate those renewables because it can be ramped up and down really, really quickly to help integrate those intermittent renewable streams as well. And we talk a lot about this in our impact report that we disclose every single year. I've just published the 7th version of this. Lots of case studies. Very happy to kind of walk investors through that.